In this module, we're going to continue what we began last module in the development industry and look specifically at the dynamics of the approach to valuation, which is used specifically for development land. Now here we're talking about development land. That's the undeveloped land that needs to be developed. When we look at the way that land values change depending on how close the land is to a township and urban area, we see a curious range. In this graph, we're looking at land values at varying distances from Sydney. Now, Sydney is the largest city in Australia, and in its centre are the highest land values. And there is what's known as the Sydney effect, which influences land values even outside Sydney proper. And so I'm going to look at a range of values here between a town called Taralga, which is about 3 or 4 hours drive away from Sydney, and so it's really well out of commuting distance. And when we look at rural land around Taralga, we find that its value is only a matter of a few cents per square metre, about 68 cents, something like that. When we come a little bit closer to another town, which is also out of Sydney, but about an hour's drive from the edge of Sydney, so I would consider that to be commuter distance. Yeah, it depends on whether you think that's crazy commuting distance or not. People are actually doing it. And we find that rural land in Hilltop, about an hour from the edge of Sydney, has risen in value to about over $2 a square metre. However, when we move to the closest edge of Sydney to these towns, to the suburb now of Camden, which not so long ago was a rural town, what we find is that the value rises up to somewhere around about the $650 per square metre area. And when we go from there to the most desirable parts of residential Sydney, we find that values over $2,000 per square metre are not uncommon, and in fact they're not uncommon to see them seriously exceeded. Now on this graph you might look at the numbers or the columns and say, well, there's not that much of a range, but if you look at the y-axis, what you'll notice is we're using a logarithmic scale. The reason we use the log scale is because those two values, Taralga and Hilltop, are so small on a regular linear scale that you can't even see them. And so I've used a log scale to bring them in a little bit. And if you look at the scales, we see that Taralga and Hilltop are in the vicinity of about $1 a square metre, whereas when we're looking at Camden in Sydney, suddenly we're looking at about $1,000 in that kind of range, that order of magnitude. Now the question is, how is it that we go from in the range of $1 or $2 around Hilltop per square metre up to many hundreds of dollars, almost $1,000 around the outer suburbs of Sydney, $650, $750 a square metre? This is the opportunity that comes from development, and this is what we really want to understand. How do we value? When we've got a piece of rural land which is on the outskirts of a city or a town, in the Hilltop situation for instance, how do we know whether it's more like the $2 or $3 a square metre or the many hundreds of dollars per square metre in Camden? And this is the major puzzle here. To understand that a little bit further, we'll look at the steps in land value growth. And what we see is that there are these thresholds, these events, which cause land to go up in value significantly. We start off with rural land value. This is where the land is valued purely in terms of its rural productivity as farmland or pastoral land or something. However, as the land moves closer to the city, and of course land doesn't really move, but what's really happening is the city is expanding and approaching the land. The first thing you find is that the land which once was remote rural suddenly is close to the edge of town, close enough that people are able to commute in. And they consider that the more attractive lifestyle of living with a few acres around you, or maybe even a few hundred acres around you, is more attractive than being cramped in a townhouse somewhere or up in a home unit where you don't even have a backyard. And so having a major urban centre nearby within commuting distance is considered to be sufficiently attractive that it pushes land values up. One step closer to the city is land which is close enough to the edge of town to be anticipated for development. Doesn't mean that it's actually zoned for development yet. It simply means that people are thinking that the city is likely to move into this area. And so this pushes lands up in front of the actual planning approval, which you'll notice is the next stage. Curious, because once the town planners say that you can use a farm as a subdivision area, this is where a big jump in the value happens. However, it's still relatively minor compared to what's about to happen. Once the land is zoned as potentially able to be developed, the next stage is to get the development approval. Development approval actually is the explicit permission, the license to be able to perform a development that again causes the land to jump up. Now, by the time you've got the development approval nailed down, the land value has jumped up to the point where it's getting close to the final developed value, less the actual hard costs of construction. And so the DA itself pushes a fair bit of the value growth. And so a fair bit of that gap, that jump between the $2.60 and the $600, well, by the time we take off, let's say, a couple of $100 per square metre for the development, so we're looking at maybe about $400 net, we're seeing the value jump from about $2, $3, $4 maybe, by a factor of about 100 times. Right? Most of that jump happens with, certainly by the time you've got the DA, a certain amount of it has happened after the zoning. So there's this kind of gradient through there. After the development application, there's still a margin, and that margin is because whoever takes that DA, it may not be the developer, they might on-sell it, and commonly they do, they still have to carry a certain amount of risk, the sales risk, the construction risk, and so on. And so there's a little bit more in it than simple developer's profit. But the lion's share, as I say, has been achieved by the time you get the DA approved. So the DA is very, very important. Now, you've seen that in the last module. In this module, we're going to assume that the DA has been acquired, and so we're going to be looking at the land as though it's got the DA. Now, the developer will tend to do this feasibility analysis without the DA because they've got confidence they're going to be able to do it, and they've got the experience and resources to be able to carry it out. Now we get to the actual core of the development approach, or the approach for valuing development land. This uses a thing called the developer equation. Now, by now you've found, or you've come across, a number of equations which are important in valuation. There was one for the cost approach, and here is the one that we use for development land. Variously, it's referred to the developer equation. That's certainly what this equation is used for. But the approach itself is referred to as the residual land value approach. And that name becomes apparent when we look at this equation. So when we look at the equation, what we see is there's total realisation, which is the total revenue, less the total development costs and the developer profit. Now, I've listed out some of the development costs, and as well as the usual suspects, the physical, civil and physical development costs, the building roads, drains and so on. There's also the professional costs, so that's the design costs, project management costs, things like that. But down the bottom there, you'll notice that there's finance costs. And this is one of the places where development appraisal is quite different to most other appraisal, because in very few other cases, say using the income approach, do you consider the use of debt. However, in valuing development land, it's common to use debt, or to factor debt, or the common use of debt, into the approach. And so that's something definitely to notice. In the study guide, I go over some of the differences between development finance and regular finance, and I introduce a concept called capitalised interest. And so it's worth your while having a close look at that. Very important concept because it suits the development industry quite well, changes the cash flows a little bit, and we'll be coming back to it in a later course. The other thing which is unusual is that the developer equation actually makes the land value the residual. What that means is it's what's left over after all of the other things are taken away. Now, normally, profit is considered to be the residual in any commercial enterprise, any investment, any profit-making project. However, here, profit, the developer profit, is considered to be some fixed factor, cost, which is able to be estimated. And in the study guide, we go through the reasons for that. But basically, it's because the developer can't afford to give himself too much profit, because otherwise he'll never be able to obtain the land. And the landowner, on the other hand, is going to put the price up to the point where it's just worth the developer's while. He's only making just enough profit for him to be happy with the level of risk. And so here, the developer profit is usually put in as a factor right at the beginning of the project, and it's considered to be virtually a fixed sum. Now, obviously, during the development, things go really well. The developer profit might be a bit high. If the development goes a bit sour, the property cycle turns against you and so on, then the profits might be a bit low. But by and large, there is an anticipated level. The traditional assumption for the level of profit, and by the way, we normally refer to developer profit, not just profit, but also developer profit and risk. And so profit and risk allowance is a very common term that you'll find. The normal level, which is used as a reference, as a standard amount for business as usual situations, is about 25%. Depending on the property cycle, the competition in the market, a lot of other things, that number can go up or down depending on the type of project. It tends to range, I haven't seen it less than about 16% sort of budgeted. Sometimes for large, supposedly more risky projects, say tower residential properties, it can go up into the 30s. But typically about 25%, so maybe 20 to 25% is a reasonable ballpark kind of area. That's the developer profit and risk allowance. Now, all of this points to the way that land is the residual. Now, I'm not going to go into that in this introduction, but I recommend that you read about that carefully in the study guide and also in the other resources we're asking you to read, and sort of think about its implications. And again, we go through that a bit more detail in the study guide. I'll just give you a simple example. Now, this is about as far as I want you to go in terms of the mathematics of the developer equation, the residual land value approach in this course. I want you to be able to identify the parts, understand reading a RLV approach valuation. I don't intend that you're able to actually go out and do all the maths, because the maths is fairly advanced and it will probably sort of rattle you a little bit if we go too far into, especially the finance calculations, which can get a bit tricky. We'll do that in advanced valuation or perhaps one of the other courses. Let's look at the application now. What we're saying is that if we're looking at a development and we have got some numbers nailed down for us, maybe an assistant or someone else has come along and done some calculations, and they present us with a development that's likely to have realisation, that's the total revenue from the sales of the developed space of $8 million. And to get that, we've got to spend something like $3 million for construction costs, and we're going to have interest costs of about $390,000, and we're going to allow, let's say, $1.6 million in profit and risk. What's the land value? The land value here is fairly easy to calculate. Simply subtract all of those costs, including the profit and risk, from the realisation, and we end up with a tad over $3 million. It's as easy as that. Now, of course, putting in all the details is a fair bit more work, and so getting those nice crisp totals that I've given you there requires looking at comparable sales, doing estimates, talking to builders, finding construction costs, inquiring with council to find out what other contributions and whatnot have to be made, and all that sort of thing. So there's a fair bit of research that's involved, and so these are not small valuations. However, the basic valuation approach is just what you see there, a very simple subtraction with land being the residual. Now, one of the things about the development industry is that it's very sensitive to what's known as the property cycle. Now, a number of you, the word property cycle won't be a surprise. You know that over a period, and a lot of people believe it to be about every 8 to 10 years, property goes through booms and busts. Big deal. The big problem for the developer is that development tends to run over periods of about sort of 1 to 2 years commonly. Sometimes developments can get up and out in less than a year, say for small subdivision developments, but for large, more complicated stage developments or large space developments, towers and things like that, it can run over 2 years on occasions. What this means is that if the developer is operating, let's say, in the middle of the cycle, okay, if we've got an 8 to 10 year cycle, what that means is we've got about 4 years up, 4 years down, or 5 years up, 5 years down if we've got a 10-year cycle. If the developer starts developing, let's say in year 3 or whatever of a upswing, what that means is in the 1 or 2 years that it takes the development to get out of the ground and get sold down, there's a fair chance that you're going to be getting close to the end of the cycle, a property bust. Usually that's marked by things like interest rates or debt generally becoming difficult to come by. People stop buying things. Occasionally prices even go down numerically. The developer is left with a lot of debt, a lot of property they can't sell, and perhaps a lot of property they can't sell in the face of falling prices. Very ugly situation. And so developers don't like the property cycle. Whereas for other property investors, okay, you bought a property, you have tenants in it or what have you, property goes up, property goes down, well, you just kind of sit through the cycle and hope you don't have to sell until you're well out of some downtime into a upturn or what have you. And so conventional property investment isn't so affected by the cycle, even though it might look a little bit gloomy on occasions. For developers, it really hurts. I've mentioned a couple of things about the nature of property cycles in the study guide, especially the fact that it's not quite a cycle. It turns out that the upswing tends to be probably about 80% of the property cycle. So out of a 10-year cycle, you might have 8 years going up. You might have a year of correction, in other words, down directions, gloom. And then you might have it sort of sitting around the bottom for a year, and then another 8 years kind of coming up. So in a 10-year cycle, you might have 8 years going up, 2 years coming down, basically. You also find that you don't know cycle to cycle whether you're going to have a short cycle, a long cycle, a big cycle, a shallow cycle. And so they're not really as repeatable as the term cycle suggests. However, it's important in the development industry to be very sensitive to the cycle. The really big problem with the property cycle and developers is that often people get swept away with the euphoria in a long upswing. And it sometimes takes people a few years to get feeling optimistic and feeling like jumping in and becoming a property developer. They're seeing other people come out as successful property developers, and they think I can do that too. And by the time they finally get around to doing it, they find that they're just about the top of the market, which is very dangerous. And often in major property cycles, what you find is it's the inexperienced developers, people in fact who often don't know anything at all about development, they've just got some money, or maybe they're a builder with a little bit of experience and frustrated with only taking builders' profits. And they finally put their toe in the water and become developers just as the crash is coming. And that tends to be one of the sad stories about the development industries. A lot of people go bust. But oddly enough, usually it's not the people that are sober developers who have experience and to a certain extent the sense of self-restraint, not to simply be hopping on bandwagons here and there. And so that really sort of separates developers into categories of mature, prudent developers versus the opportunists, the speculators, who often give the impression that the development industry is rather a nasty game to play in. I want to just finish with some closing observations. I find the development industry and the whole development activity probably the most exciting part of the property industry. Perhaps because I spent a few years working in it, quite a few years in fact, and I found that in the up times it was all beer and skittles and wonderful, and the down times people were sort of leaving and selling ice creams for a living and that sort of stuff. But there are a few little maxims that get around the industry that are worth your while being aware of. And I've got two of the most important ones up here, and also a discussion point, which is the third point, and we'll just finish by going through these. The first one is that a developer makes his profit when he buys the land. Now, if you go through the developer equation and you think about the timing and those different things, the developer buys the land today based on his estimates of the values, the costs and the realisation, which is going to happen 6 months, 12 months, 2 years down the track. Once he buys the land, he has locked in his P&R allowance for the project. And what that means is if he's made mistakes in his calculations, especially if he's been too optimistic, it's likely that his profit is going to be way down, and there's almost nothing he can do to change it. On the other hand, if he buys a cheap block of land somehow and it's really ripe for development and he's paid less for it, maybe he's bought that block of land at Hilltop for the $2 or maybe $10 a square metre, and he sort of gives the owner a really good deal, and it turns out that Hilltop is rezoned. Suddenly he finds that regardless of what he does, he makes a profit. And so that profit is largely dependent on what the developer pays for his land. Okay, it's worth kind of reflecting about that, and especially applying it in your life if you find yourself close to the development industry. The second is a maxim that gets around the property industry. Those of you who are working in the industry have probably heard this one before. Any fool can make money in a rising market. Now, this holds equally for property investment and property development, but it's even most pertinent for property development. And this is where we see what a banker friend of mine refers to as the wood ducks coming out of the forest and into the development industry when they see everybody else making a lot of profit. They don't understand property, they don't understand the economy that much. They do have a bit of money in their pockets, and they see, well, you know, I know all these people who have made bags of money as developers, and I'll do that too. They come in, and if it's a rising market, they'll find even if they're making a lot of mistakes, their project management isn't very good and all the rest of it, they'll still make profit, because during that 2 years it might take to get the development to happen, the underlying property values are going up. Maybe they've doubled in that time, which means you can be way out with their estimates and still make money. And so any fool can make money in a rising market. The same thing happens, by the way, in the investment area of property as well, but not quite so spectacularly. Of course, it's nice to be a fool who's made a lot of money in a rising market. The worst thing is the fools who think they're smart because they have made money and they go in for a second time round. And I guess that's sort of like gamblers in any area. And that largely accounts for why a lot of developers numerically go bust. The last point I want to make is that the real risk of development are not what they appear. Now, you probably have to read the study guide a little bit sort of carefully to follow through the logic of this argument, and I'll just close with this because I don't want to take up too much of your time. But if you look closely at the development equation, we've already put an allowance of 25% in for the developer's profit. What that means is that if everything goes according to plan, the developer comes away with 25% on his money. Now, if he does get the development up and finished in 12 months, maybe 18 months, 25% is an awful lot better than you'll get with bank interest. It's a lot better than you'll get by buying shares in the stock exchange. It's actually good income. And it's basically built into the pricing of the land, which is basically built into the very fabric of the development project. What that means is that in terms of your probability of actually making a loss, it's only if the circumstances go spectacularly astray, which usually happens when the property cycle goes belly up, is that you're likely to really come out a lot worse off. And to actually make a loss in development is, I won't say it's impossible because a lot of people manage to do it, but certainly for anyone with a little tiny bit of prudence and a little bit of common sense, it's actually a lot more difficult because of that 25% which is built in. Sure enough, some developers might find that they come away with a different profit to what they bargained for. Now, in a really bad time, you might find a developer barely making wages, plus maybe a modest rate of interest on the equity that he puts in. I go through an example in the study guide. And so they might only make, let's say, 8 or 10% on their investment and so on over their time. They don't make their 25%, they're sad. However, 8 or 10% again is a lot better than buying government bonds or some other secure form of investment. On the other hand, if things go really well, if you're a developer who comes in, buys the land at the right time when everyone's getting around with a bit of gloom, and the landowners don't think that the development industry is going anywhere, you buy the land cheap. However, if during that time property gets a bit of a kick along, interest rates go down or something, the Australian Treasurer sort of suddenly announces some wonderful deal with China or something, and property prices go through the roof, you might find yourself, instead of making it 25%, you might make 35%. Most people don't concern themselves too much over the risk of making more money than they expected. And so overall, what are we saying here? The real risks of development are not what they appear. Certainly the risk of making a total failure is considerably less than expected, and so that's worth giving some thought to. It also explains why the development industry has become such an important part, relatively speaking, of the economy. Okay, from here, as I say, I don't want you to go into the heavy mathematics of the development and the RLV. When you go through looking at the sample valuation report, again, don't get lost in the mathematics. Hopefully, as a result of these two modules, you will now understand the terminology, the overall mechanics of the development process, and also now you know the bones of the residual land value approach.